Okay, what's up everyone? This is Scott here again with a brand new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And of course, with today being Friday and the start of a brand new month, once again, I put together another video that will show you all the trades and all the adjustments I made over this past week. And so in this video in particular, you're going to see a few things. One, I definitely did make a lot of adjustments to a various number of my positions. Some of these guys here are giving me a bit of a hard time. So you're going to see that. And then also I put on some new trades in Kohl's, also in GDXJ. And then I did also play the Bed Bath & Beyond earnings announcement, but that trade unfortunately went terribly wrong within 24 hours because we'll come to the charts real quick here. Already have Bed Bath & Beyond pulled up. I'll zoom in. And that's because on the morning that these earnings figures were announced, the stock gapped down by over 30% and just totally blew out my short put options that were part of a short strangle strategy. So as per the title of this video, you're going to see how I managed a short strangle in basically a worst case situation. What should you do when your strikes get totally blown out overnight? And frankly, what I did is pretty darn simple. And then finally in this video, I'm going to quickly go over my current positions so you can see where everything is at today. Now, as always, before we fully dive in here, in case you are brand new to the channel, I just want to let you know that you can also find me on Skillshare as well, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for Skillshare using any of those links, you'll get a full 1-month free trial. And so with that said, I'm going to stop here and play a few clips that I recorded from this past week that will show you the various adjustments and new trades I put on in real time. So let's get started. Okay, today is Tuesday, September 28th, and looks like here we have another very exciting day of selling in the market. I'll zoom in here a bit. And so what I'm looking at in particular is a chart of SPY. This is an ETF that tracks the S&P 500, and take a look at what's been happening here today. SPY is down by almost 7 points, which equates to about a 1.5% down move. So of course, by no means are we crashing here today. This is actually a pretty moderate down move, but given what the market's been doing for the past year and a half or so, just climbing up lazily every single day, then even a 1.5% down move like this is still rather significant, especially when this is happening on the heels of about a 5% down move over the past 2 weeks or so. So who knows, I personally would love to see a continuation down lower in the market. I, for one, am getting pretty damn tired of seeing the market climb higher every single day in a row. And also, when the market is in turmoil, especially when it is going lower, you will almost always see large expansions of implied volatility, like what we're seeing currently. And in case you are not aware, one of the many ways to interpret implied volatility, which is what this graph down here is showing, is it's a measure of fear or uncertainty in the market. And of course, people tend to get a lot more fearful when stocks go down, right? So the higher the implied volatility, the greater the fear there is in the market, and also the greater option prices will be across the board. And that's because implied volatility is one of the many factors used to price option contracts. So ultimately what this means is for someone like myself, who's an option seller, I want to sell options when they have high inflated prices, because that's going to yield the biggest profits for me. So bringing it full circle, that's why I do like to see big down moves in the market, or at the very least, a lot of two-sided action, because it's in moments like that where implied volatility is high, option prices are high, and therefore I can make the largest profits. But when the market is just climbing higher lazily every single day, there's hardly any fear in the market. And as a result, it's a lot more difficult to find options that are actually worth selling, options with inflated prices. So anyways, I just wanted to point this out here today. And also one more thing, let's take a look at the VIX futures contracts. Go to /VX, and I'll zoom in here a bit. And let me move these charts down. And there we go. The VIX futures contracts will also show you the implied volatility for the S&P 500. So essentially this chart here is basically the same. If I go back to the SPY charts real quick, it's basically the same thing as this chart down here below. But of course, I prefer to look at the VIX futures contracts because obviously there's a lot more detail in that other chart. So let's go back here to /VX. And like I was saying, yes, a lot more detail in this chart. And as you can see, the VIX is up by about 10% just today. So this is a very large move in implied volatility for the S&Ps. And also, as you can see from last week, there was a huge explosion in fear or uncertainty. So we'll see what happens this week. Again, I would love to see a continuation of the fear, a continuation of the downside price action in the market. because that's going to bring a lot of opportunity for option sellers. Now, I did also look at my watch list this morning to try and find new positions to put on today, because of course I wanted to take advantage of this higher implied volatility, but unfortunately a lot of the stocks that do have elevated levels, those stocks have earnings coming up very, very soon, a lot of them in October. So that's why I'm just going to have to sit here and wait for those earning dates to come up, because chances are when those events do arrive, implied volatility for those stocks might be even higher than where it is right now, or at least they might be roughly at the same level. That being said, I did also make some adjustments this morning on a few existing positions, which you can see here in Peloton and also EWZ. Now my EWZ position, which you can see down here, this is simply a naked put option position where I sold 3 contracts of the 33 strike puts, and these expire in the October expiration cycle in about 17 days. And unfortunately, with this big down move in the market, EWZ is also down, and unfortunately this ETF has breached my put strikes yet again. So right now, if we come to the charts real quick and go to EWZ, you can see that this one is down by about 2% today, right here, and the current price is $32.65. And as a result, that's why I had to step in and short 300 shares of this ETF. And as long as EWZ remains below my put strike, I will continue to hold on to those short shares. Because in doing so, then it does not matter how much lower this ETF actually drops. The main goal of my option trading strategy is simply to keep the premium I sold options for. So in the case of EWZ here, I sold these put options. We'll go to the October expiration cycle. There we go. I sold these puts for about $110 each. And so if these options expire out of the money, great. Or I should say, if these options stay out of the money the entire time over this expiration cycle, then great. I don't have to make any adjustments. But in cases like this, where the ETF does actually fall below my put strikes, then in that case, I have no choice but to short all 300 shares of this ETF, because that will allow me to cover my full obligations on these put options and still walk away and keep the premium I sold the puts for. So that's my EWZ adjustment. Let's come back to the monitor tab. And then also, like I showed you, I did have to make some adjustments in Peloton as well. And so in a similar fashion to EWZ, this stock is also down pretty hard today as well. And so if we zoom in here, Peloton is now down to just above $89 per share. And my short puts on this stock, I forgot to mention that, this position is also just simple short put options. And my put strike is at 92 right there. So once again, with this stock pushing below my put strike, I had no choice but to step in and short the full amount of shares to cover my obligations on the put option. So in this case, because I'm short only one put contract, that means I had to short only 100 shares, not 300 like with EWZ. That being said, however, there is one major difference with this adjustment, and that is, if I come back to the monitor tab real quick, this stock actually gapped down on the opening of the market today. So this in particular is the order to short 100 shares of Peloton, but I did not get filled at a very good price. The goal here was to short these shares if I ever needed to, right when the stock breaches my put strike at 92. However, as you can see here, I only got filled at a price of $90.50. So that means even if this stock continued lower and I never had to buy these shares back again by the expiration date, or if Peloton did reverse and it went back above my put strike, in either case, I'm going to lose $150. Because think about it. Let's come back to the trade tab real quick and go to the Peloton charts so I can make this more visual. So again, let's say Peloton just continued to push lower over the course of the next 17 days until the expiration date. And perhaps by October 15th, let's say Peloton was down to $80 per share. Well, in that case, I'm going to get assigned on my put option, in which case I'll have to buy 100 shares of this stock at a price of $92 per share. So let me actually bring up the calculator here and make this even more simple. So if I have to buy these shares back at $92 per share, but I was only able to short them at a price of 90.5, that means I'm going to lose some money. And so in particular, again, if I shorted the shares initially at $90.50, and then I have to buy them back at a price of $92, that's a loss of $1.50 per share, times the 100 shares, that's a loss of exactly $150, just like I said. So that's the first scenario. The second scenario is if Peloton does actually reverse and move back higher above my put strike. And if that happens, I'm going to buy these shares back again at $92 per share. So the final outcome here, the final outcome of whether or not this stock continues to go lower, or if it does reverse and push back above my put strike, in either case, I'm going to buy the shares back at $92. It's only that in one situation, I buy the shares back because I got a sign on my put, whereas in the other situation, I just buy the shares back because Peloton is recovering. But it still leaves me with the same loss of $150. And so ultimately, in order to compensate for that, I had to step in and sell an out of the money call option. Because in doing so, I take in extra credit on the total position, right? And you can see back here on the monitor tab, I sold this call option right here. Here's the order. I sold that call, the 98 strike, at $175. And that's great because I know that I will always lose $150 from the stock here, no matter what I do. But if I can make that money back plus extra by selling an out of the money call option, then awesome. I've totally canceled out that $150 loss. But of course, the caveat to doing this is now I have a very different position on. Before, I just had a simple naked put option, and now I have a short strangle. So now that means if Peloton does actually reverse and go back higher at some point before the expiration date, and also if it pushes above my call strike now, which is at 98 right here, at this point, I will have to step in and buy 100 shares of stock to cover my obligations on the call option. So in the end here, definitely a bit annoying that this stock has moved down lower almost pretty much every single day in a row for like 2 or 3 weeks. This is definitely something I don't see very often, but I still definitely have a very good chance of making a full profit by the expiration date. I will simply just have to wait all the way until October 15th, because only by doing that will I actually be able to squeeze out every last penny of extrinsic value remaining in these option contracts. Right, obviously with my call option, for example, this option is well out of the money, but it's still worth some value. As you saw on the monitor tab, I sold this call for $175. But the only way I get to keep that full amount of money is by waiting all the way till October 15th. And also my put option too has extrinsic value remaining as well. If today was actually the expiration date, this put option would only be worth about $370 or so. But of course, as you can see, the price is still well above $600. That's because there's still extrinsic value or time value remaining in the contract. And again, it's that time value that I'm trying to slowly squeeze out of these option contracts to make my profit. All right, today is Wednesday, September 29th, and the stock I'm looking at here is Bed Bath & Beyond. And the reason why is because this stock does have earnings tomorrow morning before the market opens. So that means I have to place a trade today before the market closes to be able to put this trade on at all. And I definitely do like trading this stock a lot because the implied volatility for Bed Bath & Beyond is usually pretty darn high. Right now, the level is at 86%, which is on the higher end for most individual stocks. But you might notice the IV rank is only at 11%. Why is that? Well, Bed Bath & Beyond is also a meme stock, or at least it had periods in the past where it behaved like a meme stock. So you can see with the price action chart, there were a couple short squeezes that did occur alongside with GameStop or AMC or a few of the other meme stocks as they're commonly referred to. And these events can really skew the implied volatility charts. So in particular, you can see with this first massive short squeeze, the implied volatility for this stock absolutely exploded all the way to just under 300%. And so keep in mind how IV rank this indicator is actually calculated. It specifically compares the current level of implied volatility to the 52-week high over the past 1 year and also to the 52-week low, which might be somewhere around here, for example. And so because the high was just so freaking high, so much greater than where the IV is now or anywhere in the past, that's why IV rank is pretty skewed for the time being. Basically, once this data point rolls off the chart, after 1 full year has passed, then at that point, IV rank will become a lot more useful. And that's why I also look at IV percentile. Both these metrics will show you how high or low, relatively speaking, the current level of implied volatility is, but they simply analyze implied volatility through a different lens. And so IV percentile actually looks at the current level of implied volatility, but instead of comparing it to only 2 data points, the 52-week high and the 52-week low, it compares it to all the data points over the past 1 year. So right now, the implied volatility for Bed Bath & Beyond at 86% is currently greater than 51% of all the past days from the previous 12 months. And this is pretty decent. Generally speaking, I do look for IV percentiles around 50% or greater, and also IV ranks above 30%. But again, because in this case, IV rank is skewed for the time being, that's why I'm just going off of IV percentile. And so of course, as with all earnings trades, the reason why implied volatility for this stock is elevated is because there is increased uncertainty or fear around this particular earnings announcement. But also, once those figures do get released tomorrow morning, all that fear and uncertainty goes out the window. And therefore, you will almost always see a huge contraction of implied volatility after that point. And therefore, also a huge contraction in the prices of the options on this stock. So that's why right now, before the market closes, I want to sell some options while they still have high prices. And then tomorrow or someday in the near future, buy those contracts back for hopefully a much lower price. So with that being said, let's come on over to the trade tab now and take a look at the option chain on this stock. I am now in the November expiration cycle. These options here expire in about 51 days, or exactly 51 days. And so as you can see, based on what I've highlighted here, I'm thinking of selling the 19 strike put options along with the 29 strike call options. This is basically going to be a totally delta neutral short strangle, right? Because the delta on the puts at 24 is pretty much exactly the same, very close to the delta I'm selling on the call options at 22. So I'm not taking any directional assumption on this earnings announcement. I don't care if this stock goes up or down. I just want it to move within the expected amount. And the expected amount you can see up here in yellow. This number here will basically pop up when implied volatility for whichever stock you're looking at is elevated. And it will show you the 1-day expected move for the stock based on the implied volatility. So right now, over the next 24 hours, Bed Bath & Beyond is expected to move up or down, plus or minus, by about $3, which for a $22 stock is actually a huge amount. That's well over 10%. That being said, in my experience, having made a lot of these earnings trades, the vast majority of the time, the stock does move less than what's expected. And usually when that happens, you will see a very large contraction of implied volatility. IV will typically still contract regardless of what the stock does, even if it does move beyond the expected amount. But especially when the stock moves by a small amount, that's when you see the biggest contractions in implied volatility. And also, of course, the biggest profits. So given that expected plus or minus $3 move, that's why I've picked my strikes to be at least that far away. Right, the 19 strike puts are about $3.30 away at the moment. And then the 29 strike call options are almost $7 away. And that's because this stock, along with many other meme stocks, does have significant call skew, which basically means even call options that are super far away, super far out of the money, still have pretty high prices. And that's just indicative of the fact that right now the market is still pricing in more risk to the upside for these kinds of stocks, which should be obvious given what Bed Bath & Beyond, GameStop, AMC, etc. has done in the past. These stocks have exploded to the upside. So again, because of that call skew, that's why I can sell my calls pretty far away and still collect a decent credit on them. So with that being said, let's go ahead and right click and go to sell and then strangle. And that brings up the order down here. I'm going to sell 2 contracts each, 2 calls and 2 puts, 29 strike call, and then of course the 19 strike put, which is right there. Total credit received per strangle is going to be about $180. So in total, that's $360, pretty good. And so finally, last step is to go to confirm and send, double check the buying power requirement, and wow, less than $500 on this position. That's pretty small. So this is definitely within my sizing parameters. That's great. And lastly, we'll go to send. And there we go, just got filled at 179. I did have to come down just by a little bit. So that's great. And then final step here is to set up my buying order to buy these contracts back. So we'll create a buy order down here. Going to buy back 2 contracts and of course 29 strike call, 19 strike put. There we go. And we'll buy them back for half price. So half of 179 is about 89 or so. And then we'll make this a GTC order, confirm and send, all done on Bed Bath & Beyond. And so like I said, ideally come tomorrow morning when these figures do get released, I do expect to see a very large contraction in implied volatility for this stock. And if it's large enough, I could buy these contracts back for half price tomorrow, but chances are it might take a few more days. All right, today is Thursday, September 30th. And as you can see here, it definitely was a pretty busy day, made a few adjustments, and also unfortunately had to close out my earnings trade on Bed Bath & Beyond for a pretty nasty loss. So yes, my 8.5-week winning streak has finally come to an end, and that's because this stock did have a huge move on the opening of the market this morning, and that totally blew out my position. But as you'll see in a second when I show you this trade, the losses were still not that bad, and they're pretty darn manageable. And there are some key takeaways that I also want to discuss as well. Now also one thing to note here is I was trying to record this clip earlier today in real time, but unfortunately for some reason the audio did not record, so So here I am after the market has closed, and I'm going to record this once more, but obviously I can't show you some of the trades I made in real time. I'll still review them, but again, can't show you them in real time in this clip. So starting off first with Bed Bath & Beyond, let's take a look at the charts here for this stock. I already have it pulled up. And so as I showed you from yesterday's clip, I'll zoom in here a bit, the expected move for this stock on the opening this morning was up or down by about $3. However, Bed Bath & Beyond did open down by about $7, more than 2 times the expected move, all the way down to below 16 bucks per share. So clearly, Bed Bath & Beyond missed their earnings expectations by a huge amount. Their expected earnings per share was about 53 cents, but their actual earnings per share was only 4 cents. So again, definitely missed the mark by a huge amount, and that's why the stock got absolutely killed this morning. Now, in rare situations like this, and this is pretty much a worst case scenario, can't get much worse than this on just a one-day move. In situations like this, I will typically just close out the entire position and just move on. Right? Because with my strategy, as I explained with my EWZ position and also Peloton, let's come to the trade tab real quick here, and we'll go into the November cycle for Bed Bath & Beyond. As I've explained, if the stock does breach my put options here, I will short shares of the stock. And ideally, I want to short those shares as close to the put strike as possible at 19. Now, it's definitely okay if I miss the mark by a little bit. Sometimes if the stock does gap down in the morning, for example, if Bed Bath & Beyond opened at $18.50, that's not a huge deal. I would still short the shares and carry on. But because this stock gapped down by over 30% this morning, down below $16 per share, there is just no reason to short the shares this far away from my put strike, right? Because if I did go forward with that, and if Bed Bath & Beyond did reverse and go all the way back to and above 19 bucks per share, I would have to hold on to those short shares the whole way. That's just what my strategy requires me to do. So if I shorted the shares around 16 and bought them back around 19 and did so for 200 shares, that would be an overall loss of about $600. And given my initial credit on this position was around 360 bucks, that means even if I made adjustments, there's still probably no way I could make a profit by the expiration date, which is also 50 full days away. So ultimately, as a result of all these things, that's why I decided to just throw away the position, get out, and move on. And real quick, if we come back to the monitor tab, we can take a look at how much those losses actually amounted to. So I'll bring up the calculator real quick, and we can do some real quick math. So if you recall, I sold each of those Bed Bath & Beyond Strangles initially for 179 bucks. And this morning, as you can see, I bought each of those Strangles back for a debit of 466 bucks. So I subtract from this 466, and that's an overall loss of $287 per Strangle times 2 Strangles. That's a total loss of 574 bucks. Ouch. But I'm actually kind of glad this happened because now I can show you a very important thing about losses like this, specifically losses in a worst case scenario. And that is, this kind of situation illustrates just how important, how crucial it is to keep your position sizing small and consistent across the board. Right? For this trade, I sold only 2 contracts, 2 calls and 2 puts on a stock that's only about, or that only was about 22 bucks per share. And as you saw from the previous clip, the buying power requirement was about 500 bucks, a very small amount. And so it was for that reason, because I stayed small with this position, just like I always do, that's why the losses in a worst case situation only amounted to losing about 1% of my total account, right? 574 bucks out of a $50,000+ account is only about 1%. Moreover, as you can see down here, my P&L just for today, I did lose $446 in total, which is less than the amount of money I lost on just my Bed Bath & Beyond position. So this here illustrates another point I want to make about staying small, and that is when you do stay small with each position, this allows you to have many positions on simultaneously, which of course allows your portfolio to be well diversified and also allows your portfolio to absorb a negative impact, a loss, on any one position. Right? As you can see, I made money on a lot of my positions today, and these small profits compensated to some degree for the losses I took on just Bed Bath & Beyond. So actually, when you add it all up, I really lost less than 1% of my entire account from today. And I'm still on track to make a profit overall for this month of September. It's obviously going to be a smaller profit thanks to Bed Bath & Beyond, but it's still going to be a profit nonetheless. So again, one last time, keep your position sizing small and consistent. Ideally, if you can allocate less than 5% of your account for any one given trade, and I'm referring to the buying power requirement when you put on the position, keep that buying power requirement 5% or less of your total account. Although if you do have a small account, maybe a few $1,000s, you can go a bit higher, maybe up to 10% at the maximum, but still keep that buying power requirement small relative to your total account size. So that's Bed Bath & Beyond. Now let's take a look at my new position in Kohl's that I put on today as well. As you can see by this order, I sold 2 contracts of the 42.5 strike puts. So we'll come to the charts and see why I did that. Go to KSS, or oops, too many S's there, KSS, there we go. And we'll zoom in here a bit. So today, this stock, along with other retailers like Nordstrom and of course, Bed Bath & Beyond, this stock is also down pretty hard today as well. It finished about 12% lower than yesterday. And it seems the reason behind this down move, if you come over here to the news section and we'll go to KSS, and we'll take a look at this story which came out this morning. And basically the headline is good enough. You can see Bank of America downgrades Kohl's on supply chain issues. I honestly don't know much more about this story than that. And also that B of A is reducing their price target for this stock from 75 down to 48. That's a pretty big haircut. But again, if 48 bucks is now their new profit target, this stock actually fell down to a low of around 40, just under 46 bucks per share. And it was around this point at the low of this candle. I'll zoom in a bit more. It was at around this point where I stepped in and sold those 2 naked put options, right? Because at this point, I thought the stock was a bit oversold. It was obviously below Bank of America's price target by a few bucks. Also, if you look at the RSI indicator, this one will tell you how overbought or oversold the stock is. And this indicator at the time was below 30. And when that happens, that's a very strong indication that this stock is oversold and possibly due for a correction, or basically a short-term bounce. And then also alongside that big down move, especially early in the morning, implied volatility absolutely exploded, which is usually the case on very large down moves. So a lot of different things added up to a pretty good opportunity here on Kohl's, and that's why, again, I pulled the trigger and sold 2 puts at the 42.5 strike. Pretty far away. I did want to be a bit on the safer side because, one, the November expiration cycle, which is the cycle I chose for this trade, does overlap by a tiny bit with the earnings on this stock, right? I do believe, let's see, the expiration date is November 19th, and Kohl's, I believe, has earnings on November 18th. And unless I'm specifically playing the earnings announcement, I don't like to have earnings overlap with the trades that I'm making. But again, because the overlap here is just by 1 day, that's why I still went forward with the trade anyway. But ultimately, because of that, that's why I did want to be a bit safer and I sold puts a little bit further away. And so given that this stock did bounce a little bit today, right, you can see it did come off a bit off the lows, and also implied volatility did contract rather significantly. I think it peaked somewhere around 65% or maybe closer to 70%, and then did slowly work its way back down throughout the day. And so if we come to the monitor tab real quick and take a look at my Kohl's position, yep, you can see just from today, I'm up about 60 bucks so far. Very nice. And then lastly here, as you can see with my orders from today, I did also make some adjustments on my JD position. So again, just a reminder, if I come down here, for this position, I am short the 72.5 strike put option. I was also short the 82.5 strike call, but I did roll it down to the 76 strike call. And I did that because this stock also breached my put strike a couple times today, specifically twice, and I did lose a little bit of money when that happened. Right, just to be a bit more clear, let's come to the trade tab and we'll go to JD. And for this one, I am in the October cycle, so let me expand this tab. And so again, throughout today, JD did bounce through my put strike a couple times, which required me to short the shares and then buy them back, short them again, buy them back. And every time that happens, I do lose a very small amount of money, about 30 bucks each time. So today I did lose about 60 bucks from doing that, which did bring my total net credit on this position down below my profit target. And that's why I had to compensate for these small losses by taking in additional credit. And how do I do that? I do that by rolling down the untested side, which is the call side in this case. So basically, I bought back my 82.5 strike call and sold the new one much closer to the current stock price at the 76 strike. And when I did that, I took in, let's see, I took in a net credit of $98. So that more than compensates, more than cancels out the 60 bucks or so that I lost from having to repeatedly short and buy back the stock. Of course, the trade-off for that is I do now have a more narrow strangle. So if JD does reverse pretty hard and bounces and goes much higher now, there's a good chance it could actually blow through my new call strike at 76. It's not that far away. And if that happens, then I will have to step in and start buying shares of the stock to cover my obligations on the call option. So we'll see what happens here. There's only about 2 weeks left to go on this trade, 2 weeks before the expiration date, not much time. So I'm going to do everything I can here to keep defending this trade and maintain a nice positive net credit on this overall position. Okay, welcome back. I hope you enjoyed those few clips there. And so finally, let's go over briefly my current positions so you can see where everything is at today. And so far today is definitely a pretty good day. As you can see here, I've made back most of the losses I lost yesterday thanks to Bed Bath & Beyond. So again, just more proof that staying small is a huge advantage because your other positions that you do have on will carry you through a pretty nasty loss on any one individual trade. So assuming these profits hold for the remainder of today, then it's basically as if my Bed Bath & Beyond debacle never happened. And so now let's start off with my JD position. I'll walk through these positions pretty quickly. I know there's quite a few of them at this point. And as you can see this morning, I did have to make 2 more adjustments to this position. I did have to short 100 shares of JD stock right before the market closed yesterday. And this morning, as you can see, I did buy them back. And then JD reversed once again, went back below my put strike, and boom, had to short the shares yet another time. So right now, the full breakdown of this position is still I'm short the 72.5 strike put, and also now the 76 strike call. And then also down here in the unallocated section, I forgot to move up my new JD short stock position into the right category. So let's move this to the naked call category. There we go. And now you can see up here, I'm also short 100 shares of this stock. So for this one here, it's definitely been a bit annoying given how many times that this stock has bounced through my put strike again and again and again. But sometimes this just will happen. And that's why it's very important to stay mechanical. Make sure you have your hedging orders in place, which you can see for JD are right here. These orders are always in place to buy or short the stock, depending on if JD does cross my put strike. So it's up to you to stay mechanical, make sure these orders are in place, and make new ones if need be. Keep your losses manageable and small, and then make your adjustments when you need to. And so as you saw in one of those earlier clips, that's why I had to roll down my call option to take in extra credit to compensate for the small losses from the stock. And so as a result of doing all this, still have a total net credit that is within my profit target. And there is still room for me to roll my call down or my put up to make one last final adjustment if I ever need to. So that's JD. Next up, we come to my naked put positions. Nothing much to say about EWZ. This stock is up a little bit today. But as you can see, I'm still short the same 3 put contracts at the 33 strike and also still short 300 shares of this ETF as well. As long as this ETF stays below my put strike of 33, I'm going to hang on to these short shares. So let's move on. Next up, we have my Kohl's naked puts that I put on, I believe, yesterday. As you can see, I have not made any adjustments yet. As to be expected, this position is only 1 day old, and I'm down a little bit of money today, only about 14 bucks, but still up overall by about 45 on the position. So my guess is this stock is down by a small amount today. Let's go in and just double check. Go to KSS. And yep, as you can see, we're down in this one by about 42 cents or so. And once again, it's coming down right to that support level that I drew in. Hopefully this holds, but if not, again, that's also why I sold puts way down here. You can't even see the number on my chart, but that's why I sold the 42.5 strike puts. And that basically gives me a lot of cushion if I'm wrong, if the support level does break, because that means Kohl would have to drop by another 10% just to get down and test my put strikes. So I'm definitely not worried about this position at all yet. Come back to the monitor tab. And then of course we have my Peloton naked put, or at least it was a simple naked put. But as I showed you, I'm now also short the 98 strike call and also short 100 shares of stock. And so far, that adjustment is working very nicely. We'll go to the charts, PTON, because this stock has continued to slide and go lower and lower and lower almost every single day in a row. This is pretty darn remarkable. And implied volatility is definitely not helping me out either. It's basically flat, not contracting, not really expanding either, but I'm certainly not making money from implied volatility. At this point, it's pretty much just time decay and also the short shares of stock. And so just to get specific here, we'll come back to the monitor tab. And you can see just focusing on the 92 strike put option today, on that put, I've lost almost 100 bucks. But right above it is the short shares, and I've made back over 145 bucks just from the stock. And then of course also my call option is a bit profitable today given that Peloton is down. So overall that's why I'm up on this position today by about $75. And then next up here down below, we have my 4 short strangle positions. First up is Alibaba. And like many other Chinese stocks, this one also has continued to slide and go lower. So we'll go to the charts real quick here. BABA. And BABA is now making new lows for this year actually. currently down to about 143 bucks per share, a full $7 now below my short put strike. And this stock also has bounced through my put strike quite a few times, and I've lost a little bit of money along the way. And so in a very similar fashion to what I did with my JD position, I did roll down my call option for this position. I rolled down my call from the 190 strike, I believe, which is right here, all the way down to the 162.5 strike. And in doing so, took in a nice hefty additional credit to compensate for the losses I took on using the stock as a hedge. But now it seems with the stock well below my put strike, I do not expect to see Alibaba bounce back above 150 anytime in the near future. If it does bounce back, it will probably take a few days at the very least. But who knows, this stock just might continue to slide lower and lower and lower. There's a lot of stuff happening in China right now, a lot of bad things. And obviously their entire stock market is taking a huge hit as a result. In fact, if you go to the charts and go to FXI, this is an ETF that tracks the Chinese equity markets. And you can see just how far their markets have fallen from the past year, right? From top down to the bottom, which is where we are now, the Chinese market is down by about 30%. That's a pretty big amount. But fortunately, same thing as you saw with my Peloton trade, the short shares on Alibaba are working very nicely, right? Because as you can see here with the 150 strike put today, I'm down 225 bucks just on that put option. But on the 100 shares of short stock, I've made back $418. And then again, of course, also with this stock being down, that's why my short call is also profitable by about 65 bucks. So in total, definitely having a very good day on Alibaba, but I still have a ways to go to make back all the money I lost from using the stock as a hedge and then eventually reach my profit target. Next up, we have my new GDXJ position. This is something I was not able to record this week, and that's because I literally put this position on a few minutes before the market closed on, I believe, Tuesday. And this was a very simple position. I won't spend too much time on it here. We'll go to GDXJ. And for those of you who don't know, this is a gold miners ETF, so it very closely tracks the gold market. And for this one here, I just put on a bullish-skewed strangle. Because earlier in the week when the market was selling off pretty hard, the implied volatility for this ETF did expand pretty significantly. And so one, I wanted to take advantage of that expansion in implied volatility. And then also directionally speaking, I did want to get a bit bullish on this ETF as well. I think gold has been getting absolutely hammered over the past few months and should be due for a short-term correction. That's just my opinion. So for this one here, we'll come to the trade tab. I sold, and I'm in the November cycle for this one. So for this trade, I sold the 37 strike put options, pretty close to the current stock price, and then also the 44 strike call option. And so again, with the delta on my put being 40 and the delta on the call being only 17, that's what makes this a bullish skewed strangle, right? This position will become more profitable if GDXJ does rally, and then of course also if implied volatility does come back down. So that's it, very simple trade there. Let's come back to the monitor tab. 2 more to go. Next up, we have my Las Vegas Sands position. This is also a short strangle. I have not had to touch this position in quite a while. No adjustments, still short the same options, 33 strike put, 44 strike call. I have lost a bit of money from using the stock as a hedge from, I believe, last week and the week prior, but still have not lost enough to actually warrant making an adjustment and moving my strikes. The total net credit I have remaining on this position is still within my profit target, so nothing to do here. And then finally, we have my NUE short strangle. And this one I have had on for quite a while. But similar to Las Vegas Sands, I have not had to touch this position in a long time either. And that's because this stock is well below my put strike of 110. Right, you can see here I'm also short 100 shares of this stock. And you can see over here the P&L open column. This is the total amount of money I've lost or made from the beginning of the position, not just from today. But since I opened this trade on just the put option, I've lost about $1,300. That's a lot of money. But because I shorted 100 shares of the stock once it breached my put strike, from the stock I've made back about $1,385, a little bit more. And then just to give you a visual sense of where the stock is, let's come to the charts, NUE. And wow, once again, the stock is down pretty huge today. Another 4% down move. So again, keep in mind, my put strike is way up here at 110. And now the stock is pushing down to almost new short-term lows around 94 bucks per share. So if I did not manage this position in any way, if I did not short shares of stock, or if I did not roll down my call, I would be down a huge amount of money, well over $1,000 for sure. So whether you are using my approach and also taking advantage of shorting or buying the stock, to hedge a position, or if you're taking the tasty trade route, which is basically just rolling down your calls or rolling up your puts and taking in extra credit, and that's it. Whatever it is that you decide to do, you have to do something when your strikes get breached by a huge amount. At least when you are dealing with short naked options. If you're selling credit spreads or iron condors, then that's totally different. You have defined risk. But when you're just selling naked puts, naked calls, short strangles, straddles, etc., you have to do something for your defense. Because even though it's rather unlikely that a stock like this will ever go to zero, there is still a chance that this stock could go down a huge amount for some reason. Any stock is vulnerable to a huge hit at some point. So again, definitely make sure you know what to do when your trades go against you. And hopefully by me making these videos, you can see how my approach is working by either shorting or buying shares of stock and actually seeing firsthand how effective that approach actually is. And so with that being said, that's going to conclude this video. No new positions today. My portfolio is already fully allocated, so just have to wait a bit and manage what I have. So thanks so much for watching, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my Skillshare courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.